Hello and welcome to the Cedar River Capital Market Touchstones slideshow update for the first quarter of 2023. The date today is March 19th, and today we'll be discussing the main driving factors in the stock market at present. My name is Paul Latta. As in prior slideshows, I'll be doing the speaking today, but my business partner, Baj Kochar, and I are both available for questions and discussion. Our contact information is on our website at cedarrivercapital.com. Our agenda today will begin with a discussion about the recent market action, what's working and what's not working. We'll then look at the macroeconomic backdrop to put more context into the market discussion. Then we'll flip to the microeconomic point of view and look at a handful of key industry-specific drivers. And then we'll finish with a handful of longer-term observations and conclusions about the investment landscape. This is a chart of the S&P 500 over the last 5 years. Good news is that the S&P is up 57.2% in the prior 5 years, but of course last year, 2022, was a challenging year with the S&P down about 18%. And while the S&P is up so far this year, the gain is quite small at about 2%, and the market has been very choppy. There's an old investment maxim known as "don't fight the Fed." It's hard for the stock market, the bond market, or the real estate market to rally higher when the Federal Reserve is in a rate hiking campaign. This chart shows Fed funds over the last 10 years, and you can see that the Fed has been actively raising rates since early last year, and the rate hiking campaign is both bigger and faster than we've seen in some time. The main driver, of course, is inflation, mainly related to the post-COVID economic recovery amid COVID-constrained supply chains. The rapid rise on overnight Fed funds has resulted in a sizable yield curve inversion. As shown here in green, the yield on the long-term bonds is lower than the yield on short-term bonds. Yield curve inversions are not very common and are generally regarded as a recession indicator. The yield curve a year ago, shown in yellow, was not inverted but was a normal upward sloping curve. Earlier this month, the inversion reached a 40-year record at about 80 basis points between the 10-year Treasury and the 2-year Treasury. But recent news around bank failures has reduced the chance of additional rate hiking, lowering yields across the board, but more so on shorter-term bonds. You can see this by comparing today's curve in green to last week's curve in blue and last month's curve in red. Today's green curve is still inverted, but a little less so than the red and blue curves. We like this slide because it seems to capture the market mood swings over the last 9 months. Each of the last 3 quarters started strong, but actually finished weak, and overall made very little progress. The chart on the left shows the third quarter last summer, which roared out of the gates as CPI inflation showed its first monthly decline. But alas, all those so-called peak inflation gains were erased as the Fed held tight to its policy of higher for longer interest rates. The pattern repeated again in the fourth quarter. The market roared in October and November as the Fed scaled back on its pace of rate increases, but then was hammered by ongoing strong labor markets. In the current quarter, we are seeing the pattern happen a third time. The market roared out of the gates in January, mainly on New Year asset reallocation and fear of missing out. But the market then cratered in February on inflationary signs from the labor market again, plus the producer price index wholesale inflation. March has not been kind to investors, with a handful of banks failing. Will the same pattern happen again in the second quarter? Hard to say, but we are a bit skeptical since patterns like this that are easy to spot tend to be the first to get arbitraged out of existence. The ups and downs of the stock market reflect rational arguments from both bulls and bears. Looking at the bull case on the left first, clearly at the top of the list is the idea that the Fed's rate hiking campaign is very close to done and the economy is headed for a soft landing. Inflation at 6% last month is certainly better than the 9% peak last June. Additionally, bulls will highlight the money on the sidelines these days with money market deposits at record levels. Also, China is finally putting COVID in the rearview mirror, which ought to loosen up many of the supply chain issues. Stock market valuation is quite reasonable with the PE at 17.7, which is about in line with its 10-year average. And of course, American ingenuity, innovation, and invention continue to drive capital growth. Bears, in contrast, will cite 3 areas of concern. First, while the Fed may soon be done tapering, the Fed is not done yet. There are areas of structural inflation where prices continue to lift, and even if the Fed stops raising rates, that does not mean the Fed will be cutting rates, and rates are very high today. The ongoing high rate environment will keep pressure on rate-sensitive industries like home and car purchases. Second, while the market PE is in line with historic averages, it is not in line with the higher rate environment. In theory, if you double interest rates, the PE should be cut in half. We're not there yet. Lastly, The current stock market valuation is not including any discount for geopolitical risk, yet we are in a world with heightened geopolitical risk emanating mainly from Russia's invasion of Ukraine and to a lesser extent the China-Taiwan tensions. When breaking down the S&P 500 by sector, you can see that the year-to-date sector returns on the bottom are a bit of a mirror image of the sector breakdown from the prior 12 months, the chart on the top. You might recall the energy sector roared early last year amid Russia's invasion of Ukraine. Also, the consumer defensive sector became mainly a safety bet amid the hawkish Fed environment and outperformed the rest of the market. Many of the big five mega cap consumer technology names, Facebook, Apple, Amazon, Microsoft, and Google, well, they underperformed last year, partly on weak economy fears, but to a larger extent, simply as a source of funds to purchase energy and consumer defensive names. Those trends are all reversing in 2023 so far, as seen in the chart at the bottom. Energy in particular has cratered as Ukraine winter fears fade with warming weather. And the big five consumer technology names, which dominate the technology, communications, and consumer cyclical sectors, well, they bounce back into fashion. Returns by style factor so far in 2023 are shown in the far right-hand column. With the return to fashion of the big five mega cap technology names, it should be no surprise that growth stocks are roaring. The big five dominate the Russell 1000 Growth Index at over 1/3 of the index value. As mentioned back on slide 6, the market in the last few quarters has been seeing a pattern of each quarter starting strong, but then finishing weak. If we were to look at style factor returns in the first half of each quarter, and then again in the back half of each quarter, we would get a cookie cutter ranking of style factor by offense versus defense. So for each of the last 3 quarters, for example, the aggressive story stock style led in the first 6 weeks of each quarter, but then lagged in the last 6 weeks of each quarter. Income and low volatility stocks, which are more defensive, they would be lagging in the first 6 weeks of the quarter, but leading in the last 6 weeks of the quarter. So as we near the end of the quarter, it's interesting to see the net effect. It seems the rotation back into big five mega cap techs trumped the moves of the offense versus defense. Indeed, it appears the main motivator for the first quarter was to buy whatever was not working last year and sell whatever was working last year. This is a classic beginning of the year move using the age-old reversion to the mean thesis known more colloquially as the dogs of the Dow. That explains about 80% of the style factor moves in the first quarter so far. The US market has been doing a touch better than the rest of the world so far this year, up about 2%. Perhaps this is another sign of reversion to the mean given that the US modestly underperformed the rest of the world last year. Europe market's near the top of the list so far this year, mainly on the warm winter in Europe that has allowed Europe to stay warm this past winter despite little to no natural gas coming from Russia, a bit of a relief. The Mexican market has been surprisingly strong this year, a likely outcome of nearshoring efforts from the likes of Tesla and others amid geopolitical tension with China and Ukraine. Brazil is near the bottom of the list so far this year, not off to a good start with the January capital riots in Brazil. Also, there have been some discussion of a currency union with Argentina, which seems quite bullish for troubled Argentina, but not so bullish for Brazil. South Africa continues to wrestle with the electricity crisis there and the related downgrades on its sovereign debt from S&P and Moody's. Still, overall, global market performance is fairly flat for the year, and the spread between winners and losers is about in line with normal. There are no major winners and losers geographically so far in 2023. We'd now like to move on to part 2 of the slideshow, looking at the macro economy. Hopefully this will give a better context for market action. The higher interest rate environment and the present yield curve inversion has everybody worried about a possible recession. But the stock market and the economy are not the same thing. How is the economy actually doing? In short, we're muddling along. Economic growth in recent quarters has been subdued in most developed regions of the world. There is some weakness as the chart shows here, but that weakness is not everything, not everywhere, and not all at once. Inflation remains elevated here with Consumer Price Index or CPI at 6% inflation. It's well above the Fed's inflation target of 2%. The good news, of course, is that inflation peaked last June at 9% and has been trending down every month. Most of the inflation drop since June has been energy, as you can see in yellow in this chart. However, the biggest contributor to CPI inflation remains the ongoing escalation in shelter cost as measured by monthly equivalent rent. Wage pressures also remain present, though they do seem to be moderating a bit. The producer price index has also been softening, but has been more volatile. The last few months were a little on the weak side in December, a little on the strong side in January, and then weak again in February. Still, the trend for PPI has been similar to CPI. Both are trending down. In prior slideshows, we highlighted how inflation is a global phenomenon, not just a US phenomenon. After all, the pandemic was global in scope, so the idea of a constrained supply chain amid COVID recovery, well, that's not a US only idea. As the table shows here, most regions of the world saw inflation peak sometime last year. The only exceptions are China and Japan. China, of course, is lagging the rest of the world because of its COVID zero policy, a policy that was reversed near the end of last year. Japan, in contrast, is actually welcoming some level of COVID recovery inflation since Japan has been wrestling with deflation for many years. Europe inflation peaked a little later than most of the non-Asian world. This mainly reflected being closer to the disruptions in the Ukraine. Also, the European Central Bank was one of the last central banks of size to become hawkish, partly because of sovereign debt challenges that limit the ability to engage in any sort of quantitative tightening. We've referred to the warm winter in Europe in earlier slides and the related sense of relief on energy supplies during the winter peak energy season. Here you can actually see the winter of 2022-2023 was the second warmest winter on record in Europe. Not good news for skiers perhaps, but great news for those worried about heating their homes in, say, Germany with little or no natural gas coming from Russia. Winter natural gas consumption declined an amazing 22.1% below the prior 5-year average. There were other factors, of course, besides the warm winter. High prices were right at the top of the list, but also conservation, fuel switching, efficiency gains, avoided demand, and more renewables. This is our last slide on the macro situation, and of course we cannot ignore the geopolitics today. On the Russian-Ukraine conflict, we did just pass the 1-year anniversary of the invasion last month, and while there has been little movement on the front lines since last September, more weapons have been pledged by the US and other NATO countries. While the stalemate seems likely to continue, there is ongoing risk of escalation. On the China tensions, this last quarter saw large-scale military operations near and over Taiwan, an area that has already seen a large military buildup. There seems to be increasing concern about China allying with Russia, perhaps along the lines of the old maxim, the enemy of my enemy is my friend. Escalation risk or black swan risk remains here too as well. We'd now like to move on to part 3 of the slideshow, shifting from the macroeconomics to the microeconomics by looking at a handful of industry-specific factors that are shaping overall capital markets. The banking industry has been under increased focus with the failure of 3 banks of size in just the last month: Silvergate, Silicon Valley Bank, and Signature Bank. While none of these banks were regarded as systemically important financial institutions or too big to fail, the banks were still sizable and hence frightening, especially to those investors who were around during the 2008 Great Recession. The chart here shows Silicon Valley and Signature were actually the second and third largest bank failures since 2008. The stock market reacted immediately to the bank failures with a near 30% drawdown on the S&P Regional Bank Index. There were even bigger drawdowns on individual banks that were perceived to be close peers to either Silicon Valley or Signature Bank. First Republic drew down 86% at one point. Western Alliance drew down as much as 90%. Contagion then appeared to spread to Europe with a sharp decline in Credit Suisse in Switzerland, a bank that had been troubled for some time. Fortunately, the Fed did respond quickly with deposit guarantees and opening borrowing lines for the next year at par. There are 4 troubled banks at present, but there are 3 main causes behind those troubles. The root causes were either exposure to the crypto market, exposure to the venture capital industry, or if the bank was already troubled with pre-existing problems. Silicon Valley Bank clearly had the venture capital problem. In short, the deposit portfolio was largely composed of cash balances of venture capital funded companies, most of whom were drawing down deposits to stay afloat amid a bearish market where they could not raise capital. The shrinking deposits were forcing Silicon Valley Bank to liquidate its bond portfolio at a very inconvenient time when bond prices were very weak. The potential realized bond losses were of size to the point that it threatened the overall capital of the company. In contrast, Silvergate had the crypto problem. FTX, Sam Bankman-Fried, and related companies had over $1 billion in deposits at Silvergate. Deposits started to flee rapidly as headlines worsened. Signature Bank also had a crypto problem. If Silvergate failed, Signature would seem to be close behind, especially given Signature's complex client base. Credit Suisse did not have a venture capital problem nor a crypto problem. Rather, Credit Suisse had the pre-existing illness problem, a problem that magnifies when bank failures are in the press. Credit Suisse has high exposure to the rising rate environment, to the point that funding costs could exceed the overall capital of the firm. The Swiss National Bank is still working out the challenges at Credit Suisse, but at this point it appears Credit Suisse equity as we know it may not be around for long. Will there be more troubled banks in the near term? Perhaps, but our read is that the quick reaction of central banks will prevent serious contagion issues, especially at the systemically important or too big to fail banks. Of course, we're not fully out of the woods. Unrealized loan losses are sizable for many banks thanks to higher rates. And there are a handful of banks that have outsized exposure to cash-hungry venture-funded businesses or spooked crypto investors. And of course, there's always recession risk, especially given the high-rate environment. That said, central banks have stepped in and guaranteed even large deposits for Silicon Valley Bank, a move that seems to deter any fear of a run on the bank. Also, there are over 4,000 banks in the US and just a tiny handful that actually have meaningful exposure to venture-funded companies or crypto-related assets. Shifting now from the banking industry to the pharmaceutical industry, there has been no shortage of headlines around the research advances in the pharmaceutical industry, especially in the area of diabetes recently. This is being reflected in the eye-catching stock price moves. The two biggest diabetes pure-play companies, Eli Lilly and Novo Nordisk, have nearly doubled in price over the last 2 years, an impressive move given last year's bear market and the fact that the pure pharmaceutical companies have actually traded down over the last 2 years. Investors are enthused about the new GLP-1 treatments for type 2 diabetes and obesity. These include Novo Nordisk's semaglutide, which is sold as Ozempic for type 2 diabetes and Wegovy for weight loss, and Eli Lilly's tirzepatide, which is sold as Mounjaro for type 2 diabetes and is still awaiting FDA approval for weight loss. The GLP-1 drugs seem increasingly likely to displace metformin as the current standard of care in type 2 diabetes. There are a number of players in the diabetes pharmaceutical market. This table looks at the largest players and then ranks them by what percentage of revenues are derived from the diabetes pharmaceuticals. Novo Nordisk is top on that list, followed by Eli Lilly at a distant number 2. Sanofi is also reasonably large in the diabetes space, but Sanofi also sells into other disease areas, oncology, rheumatology, and others. So Sanofi and the others on this table are not likely to react much to developments specifically in diabetes. Novo Nordisk and Eli Lilly, in contrast, they will. Will Novo Nordisk and Eli Lilly stocks continue to march higher? Bulls would argue that the GLP-1 drugs are early and that there's many years of growth ahead. Further, there are manufacturing supply constraints, especially for Ozempic, that are limiting present sales but having that quirky impact of higher demand creation, specifically because people cannot get it. The more they cannot get it, the more they want it. Lastly, it's no secret that America is facing a diabetes epidemic, so an advance here may well promise to have a broad and lasting social impact. Alas, though, bears will note that the rosy outlook for semaglutide and tirzepatide is already baked in the valuations, with PE multiples for Novo and Lilly nearly triple the rest of big pharma. Also, the popularity of such breakthrough drugs is not everlasting. We've seen this before with, say, Opdivo and Keytruda in the immuno-oncology space, and outperformance for such game-changing medicines rarely lasts more than 2 or 3 years. Lastly, both Novo and Lilly face new biosimilar competition in their core insulin businesses, and while that may take a few years to ramp up, the ramp is inexorable. Additionally, Novo and Lilly both have R&D pipelines that might surprise, positive or negative, irrespective of the revenues. Lilly in particular has a high-profile trial due on its donanemab Alzheimer's treatment, which is likely to move the stock. Pipelines of pure pharma companies could also have some impact, as other pharma companies have GLP-1 drugs in the pipeline. We are quite pleased that Lilly in particular was one of our biggest gainers in the last couple of years. For now, we're in a holding pattern, reluctant to either add to positions or reduce positions. There have been no shortage of headlines about ChatGPT since its release on November 30th last year. Indeed, ChatGPT is the fastest growing app ever, reaching 100 million users in a mere 2 months. What is ChatGPT? Given the roaring popularity, it seems most folks know the answer already, but if you ask ChatGPT, it describes itself as an app that, quote, uses natural language processing to generate human-like responses to text-based conversation. There are many uses as shown here. It engages in conversation, writes poetry and essays, discusses philosophy, writes computer code, creates grocery lists, and more. ChatGPT is referred to as generative AI app. There are competitors to ChatGPT, including Google's Bard, and a number of smaller players. Notably, as an artificial human, ChatGPT is not perfect. There are issues with bias, transparency, misuses, copyrights, and privacy. While ChatGPT has taken the app world by storm, the impact on the stock market has been less clear. There is no ticker symbol for ChatGPT, so all ChatGPT plays are actually indirect plays. The most frequently mentioned impact is on Microsoft versus Google, especially in their search engine businesses. Microsoft benefits from adding ChatGPT feature to its Bing search engine, as there's really no way to go for small market share Bing but up. Google, in contrast, well, the core business is search, and adding Google Bard to its search business reduces the revenue it makes from its searches for links. Microsoft CEO Satya Nadella poured gasoline on Google's problem when he boldly proclaimed last month, "From now on, the gross margin of search is going to drop forever." Ouch. NVIDIA frequently gets mentioned as a ChatGPT beneficiary. There is clear merit here in that NVIDIA's H100 core tensor GPU is specifically architected for the AI marketplace. That said, we're a touch skeptical. NVIDIA has never really segmented its operations to be able to quantify the exposure. And in the past, NVIDIA has a history of strongly associating with, say, crypto when crypto is in fashion, or video games when video games are in fashion, and then changing the subject when crypto or video games go into down cycle. So we do love the core GPU technology at NVIDIA, but we are a touch skeptical. As a small cap advertising company, Perion is often mentioned as a play on ChatGPT. Perion of Israel is directly linked to Bing search revenue, where it places ads. More Bing search means more Perion revenue. And notably, Perion does not have a monopoly here, so it must share that growth of Bing with others. Some companies will be hit hard from ChatGPT. The two freelance companies are often mentioned here, Fiverr and Upwork. Also, Chegg, the online homework helper, is likely to be troubled when ChatGPT already writes the essays for the students. Earlier, we discussed the unseasonably warm winter in Europe and the palpable sigh of relief that Germans did not freeze to death with little to no natural gas for heating. Yes, the ski industry in Europe was hit hard, but there were more important priorities this winter. Last fall, in prep for a cold winter and in the absence of many Russian and Ukrainian imports, many of the commodity markets experienced unprecedented price spikes and scarcity. At the top of the list was natural gas in Europe, which spiked over tenfold from its pre-COVID baseline. But where are we today? As shown in bold here, Europe natural gas prices have dropped some 85% from the October peak. Warm winter was a huge factor. Natural gas was not the only commodity to see a massive spike on a supply shock in Europe. There's been a near identical mega shock chart on wheat and on nitrogen fertilizer. And slightly smaller shocks were experienced in the European markets for coal, electricity, and crude oil. Many of these commodities have experienced sizable, if not full, reversions. In fact, none of the European commodities that spiked last fall remain at those elevated levels. The warm winter in Europe is firstly cited as the driver in the normalization of European feedstocks, but of course, any supply shock that leads to elevated prices will induce increased production as well as conservation. Price spikes tend to be self-correcting. But notably, that correction did not fully manifest until the winter freeze risk was safely behind us in Europe. Real estate is not immune to the effects of higher interest rates. Mortgage rates have lifted from just over 3% to approximately 7% today, a big headwind. The Case-Shiller Home Price Index has declined 6.3% from its peak in June last year. Transaction volume is down hard, with existing home sales down about 40% from the recent peak in October 2020. Curiously, the inventory of homes for sale remains low, but mainly because the high mortgage rates are preventing people from moving. Another curiosity is that housing starts, new home sales, and building permits remain essentially unchanged and unfazed. Well, this is good news for forest products companies and hardware stores. This, however, seems to mainly reflect builders and developers offering incentives and financing, a scenario that seems likely to be short-lived. Looking at the commercial real estate side of things, cap rates have been lifting with higher interest rates, no surprise there. Retail cap rates are lifting a bit slower, likely reflecting a return to normal environment that is actually benefiting retail and restaurants. Office cap rates remain elevated as occupancy levels are not recovering much post-COVID as work from home becomes more of a permanent thing in many industries. Apartment cap rates have been most impacted, likely due to declining consumer confidence and pressures from inflation. We would like to finish our last section of the slideshow today with 2 additional slides highlighting longer-term trends. We've used this slide in prior slide decks and we'd like to revisit it again, mainly because we've shifted stance on bonds a few months ago from bearish to bullish, and we feel a need to reiterate this. This chart compares the earnings yield on the S&P 500 to the yield on the 10-year Treasury bond. Bond yields have lifted much more than stock earnings yields. While stocks are still the better value and have been since 2001, bonds have made solid progress. Some allocation to bonds is merited at this point. There's no rush, of course, since the Fed is still raising rates, perhaps one more time, maybe two, but a bond allocation does have merit. We generally prefer building bond ladders using target maturity bond ETFs, which we regard as the easy button. This approach retains the capital preservation feature of a traditional bond ladder, yet without the illiquidity problems. Looking longer term, it is worth remembering that up markets outnumber down markets, and not by a small margin, rather by just over 3 to 1. Average inflation adjusted return over the last 150 years is 8.4%, as you can see in the chart. But since most of us do not adjust last year's stock market gain or loss for what inflation was, the average stock market return when not adjusting for inflation is over 10%. That concludes our slideshow for today. Thank you so much for listening. Again, please reach out if you have any comments or questions. Our contact information can be found on our website at www.cedarrivercapital.com. We would love to hear from you.